Good morning. Welcome to the News Hub. I'm Rolf Winkler. The monthly jobs report is in just now, and the unemployment rate has dropped to 7.7% from 7.9%, as non-farm payrolls increased by 146,000. That's compared to economist expectations of 80,000. Barron's Brendan Conway is here. Brendan, now, people have been expecting a lot less particularly because of the storm last month.
Yeah, that's right. You know, a lot of folks this morning were saying don't pay attention to this number because of the storm. We're looking for 80,000. This number is pretty good. I mean, I think the market's going to like this, given the context of, you know, the storm basically wiping out a lot of economic activity on the East Coast.
Now, it's not just the storm that makes this a particularly that theoretically makes it a noisy report.
Yeah.
Now, you've also got other issues that make this, you know, one jobs report that maybe people aren't as worried about. There's not an election to worry about. The Fed's moves are more or less baked in at this point. It sounds like whatever this number was going to be wasn't going to change the Fed's. And anyway, people are focused on the fiscal cliff.
Yeah, you know, and what's so funny about the market is that for all the worries out there, for all that people are talking about it, stocks just kind of continue to march to fresh highs, you know, in a shorter time period anyway. The Dow closed at a 1-month high yesterday. I mean, traders are basically trusting Washington, even though the headlines out this week don't look all that encouraging.
Okay, I want to jump over to my herd on the street colleague. Actually, we're going to get to him in a second. Brendan, how do you think the market is going to react to this number this morning?
You know, I would tend to think we should see if we can get the futures up. I would tend to think that they're going to like it, just for the sheer reason that people had written off this report as not telling us very much. You know, we had this very low forecast here. I think in the short run, people are going to look at this and say, okay, you know, jobs were still kind of moving along at a modest pace. It's definitely going to get hopes up for next month's report, I would tend to think.
By the way, let's just catch people up on where the Fed is now. I mean, the open-ended bond buying program of $40 billion per month on mortgages, that's happening. We know that's going to happen. Now, I guess, have they decided yet what they're doing with that old Operation Twist, which was the $45 billion coming out of short-term treasuries going into long-term treasuries? Are they going to continue printing more money to buy long-term treasuries as well? Do we know about next year what the Fed's program is going to look like? The
kind of last big insight that we got there came a couple of months ago, where the Fed basically said to the market, you know, what traders have dubbed it QE infinity, meaning basically that the Fed will continue all of these programs, at least this is how it was read, for the foreseeable future throughout 2013. So when you kind of look at the markets and you look at what traders are saying, there's this feeling that we're going to have this low rate environment with us for a long time. I personally think that if there's a decisive upswing in job creation, if we see growth numbers doing well, that forecast is going to come in a lot faster than people think. I think there is a risk there. There's definitely a risk to the bond market from that.
Okay, hold on for a second. Check out the futures if you can on your BlackBerry. Hopefully you get reception up here. I want to bring in Sudeep Reddy from Washington, Wall Street Journal's economics reporter. Sudeep, good morning.
Good morning, Rolf.
So, fast reaction to this report.
It obviously is skewed by Sandy, but if this is a skew, then it's a pretty good one. That means that we probably had somewhat higher job growth during the month. What concerns me a little bit is if you look a little deeper into the report, you see a revision for the 2 prior months that was downward, which is a little bit surprising because we had thought that job creation was at least on a more sustainable upward trend. But to see a downward revision for 2 straight months coming into a report like this is not a very good one. Given all of the special factors involved in this, it's probably not going to skew a lot of people for the latest month. It's not going to change a lot of expectations of the labor market, but there are some signs of caution coming into the report now that might lead people at the Fed to be a little bit more worried than they were a day ago. And it's certainly, unfortunately, when you have a number that isn't as bad as it was expected to be with this latest month, it's not going to move policymakers to act. It might actually continue this notion that everything will be okay if we go over the fiscal cliff, which is a very dangerous notion.
Okay. Now, by the way, also, I'd love to ask you, since you cover the Fed for the Journal, so talk to me about how this informs what they're doing and if there's any change at all.
It's pretty clear that the Fed was going to continue its bond buying program. It was going to replace Operation Twist with something either at or close to its prior bond buying. So I don't think we're going to see a huge shift from the Fed. At the very least, a report that still shows relatively modest job growth. It's obviously not bad, but relatively modest job growth in recent months is going to keep the Fed keep the pedal down, and they're not going to want to pull back or provide any hint that they're pulling back at all. And so a measure like this is going to the Fed is not going to ease up as a result of a report like this. They are especially going to look past special factors.
Okay, thanks, Sudeep. Stand by for a second. I want to bring in my Heard on the Street colleague, Justin Lahart. Justin, you're in the newsroom. What are you seeing behind the headline numbers?
Yeah, I think that you're definitely seeing a Sandy effect here. If you dig in, you see manufacturing jobs down 11,000, construction jobs down 20,000. So, Sandy was definitely in this number, and I think that the fact that it was, so strong despite Sandy really, does say something about the underlying strength of the economy. And I think, as Sudeep was mentioning, the one concern here is it's just going to keep people from feeling any sense of urgency as they deal with the fiscal cliff. Okay,
by the way, so interesting. Manufacturing and construction had been really part of some of the sectors that had been adding to the steady improvement in the labor market, right? And if those weren't adding here, what were the sectors that I guess maybe outperformed expectations?
Well, really, healthcare, information technology, so your more service sector jobs. And construction actually hasn't been all that great a source of jobs despite the rebound in the housing market, but seeing manufacturing down, it definitely says, a little bit about Sandy, and it also says something about, maybe about the caution with the fiscal cliff, because those jobs are more responsive to that.
Okay. By the way, do we have a sense for average hourly wages in this report, or any of the other little tidbits behind the scenes here?
I still have to dig in for those. Sorry.
Okay. No worries. And we'll come back to maybe to U6. I'd love to see labor force participation. Did you get a chance, Justin, the revisions that Sudeep talked about how large they were and how much of an impact that will have on, I guess October is now revised to 138,000, September revised to 132,000. This was versus August, 192,000 non-farm payrolls were added. How did those revisions impact people's thinking, if at all?
Well, yeah, a lot of times the revision tells you something about the trend in employment. So a lot of times when people see upward or downward revisions, they get either concerned or excited. And people are definitely going to be looking at those revisions. There are some aspects of I think but seeing the strength of this number for November is probably going to trump all of that.
Okay, fantastic. I want to bring back Brendan Conway quickly. Brendan, how do the markets like this number or not?
So, Rolf, it's really interesting. For all the warnings that are kind of under there that you guys just discussed with Sudeep, Mr. Market likes this. The Dow's up 56 points at the moment. Earlier this morning it was down 22 points. So I think definitely the market is focusing on, Sandy walloped the East Coast, and yet we still have this decent number that beat expectations by 60,000 jobs or so. They definitely like it out there this morning.
Okay, great. Fantastic. Brendan, thanks so much for joining us. Pinch hitting early. And to Justin Lahart and to Sudeep Reddy for joining us this morning. Thanks, guys.